In this example, Scott and I are going to discuss some of the pros and cons of trading spreads, why you'd want to trade a spread, why you'd want to be involved in this market. Spread trading is like any other form of speculation. It's not for everybody. Trading spreads is very different than the short-term hit and run trading that most outright futures traders do. In this section, we want to highlight some of the benefits and maybe some of the drawbacks of trading spreads. Scott?
Lan, I'd say most of the general reason why most people are attracted to spreads are they tend to exhibit lower risk, they have extremely attractive margin rates, and the last one is kind of questionable, but a lot of professional spread traders say they're more predictable than the outright markets. Can definitely say that the risk is lower. You know, let's look at one of our favorite markets between both of us, the soybean market.
Okay. We're looking at the November soybean contract right here. It's the 2001 contract, and what we're seeing is a nice little topping formation, maybe a 1, 2, 3 top or something along those lines.
Exactly, and you know this is a time of year when you expect it as well seasonally. You know, the crop's been made, and we should see some type of future production coming in. You know, I agree that sure looks like a 1, 2, 3 top to me.
It's a little odd. It may be over here, maybe over there. But anyway, what we're looking for is basically a risk off the top that we want to compare in this market versus a spread market, right?
Exactly. You know, look at that difference between the two and let's just say the 2 and the 3 point there.
From a dollar standpoint, that's about $2,000 wide.
Yeah. You know, you're going to risk 40 cents there. You know, $2,000. That's a big risk.
That is a big risk.
Especially most futures traders in that $5,000 to $10,000 initial account range. Risking $2,000 is anywhere from 20% up to close to 50% of their account. You don't have much room to be wrong when you use that type of leverage. But a way to maybe diversify and lower your bet size and lower your risk would be to look at a spread.
Okay, let's look at the spread side. Now this is our soybean November 2001 soybean May 2002 spread. Buy one, sell one.
Right, and this is a new crop to new crop spread. They both represent beans post-harvest. November is typically our first real harvest bean contract. So we don't have differential between harvest years. Again, we see a similar pattern in this spread to what we saw in the outright futures.
If we go back over to the outright commodity, we can see what we're looking at here. We're looking at the same basic downtrend, right?
Right.
So we want to look at the topping pattern that we see over here. This is a little bit different topping pattern, but across the top, maybe here, the spread risk would be about $300.
Exactly, versus $2,000.
Yeah.
So what percentage is $300 going into a $5,000 account?
Now, of course, if our risk is lower, obviously our profit is going to be lower as well. I mean, if we go down and we're the smartest trader that there is and we hit the bottom of that trend, and when we get out we're making a $637 profit, whereas if we drop over to the commodity,
right, we did an outright
commodity straight off, we're going to be making closer to $3,000.
Yeah, and you'll notice that the ratios, risking $2,000 to make $3,000. Take a look at the spread. We're risking 300 to make 600, or 350 to make 600. It's similar risk to reward profiles between the two of them. It's just the dollar amount is much smaller in the spread. You also, let's take a look at, a margin rate. Margin is a definite.
We got a margin sheet. We can look at margins right here.
Yeah, margin is a definite judge of riskiness.
Now this margin sheet, we got this from the CBOT. This came right off their website.
Right, and these are exchange minimum margins.
Which, of course, can be changed by your broker. Brokers can change the margins.
Right. And they're also subject to change by the exchange at any time without notice, which the CFTC always tells us we should say that whenever we mention margins, so we did.
And, of course, I need to throw into Track and Trade the software. This comes set with the margins at the time that you've received the software. But, of course, margins change all the time, so we give you the ability to go in and change those margins, to update them and keep them reflected to what your brokerage firm says they should be.
If we go ahead and we look at this, we can take a look and say the initial margin for soybeans is, $810.
Right there.
So it costs $800. You have to have $810 in your account to trade one contract of soybeans.
And of course, your maintenance margin is over here, $600.
Right. Now, look down at the spread margins for soybeans. The initial margin is $338 with a maintenance of $250. It definitely shows you how much the exchanges in your brokerage look at margin as a level of risk. And they say, you have to have, keep that $600 maintenance in there so you can always make good on that contract we just went into. The risk is $600, theoretically. That's the safety cushion that they need. On the spread, they say because it's partially hedged, we only need to keep $250. So somebody who, you can either use spreads to be less aggressive, or you can do, 2 or 3 spreads to one futures contract. That's not uncommon either.
You notice that when people do spreads, they have a tendency to do larger contract quantities.
Exactly. It's not uncommon, for example, in the soybean market down on the floor. Let's just say it's 521 bid, 521 and a half offer. They'll put a size on that, say 20 to 50 contracts. So when I say 21 bid, I am bid for 50 contracts. I'm good for it. It's 21 and a half offer, I'll sell you 50. I don't care which. You get into a spread market, and that market can easily be 300 up, because margin requirements are less, they move less, and a lot of professionals and commercials play the spreads.
Well, you mentioned too earlier that there's the increased predictability of them, making it a little bit, more likely that you're going to make your profits that you're looking for. So increasing your quantity of contracts is a little bit more likely as well.
Exactly. If you think about some of the popular spreads out there, and we'll take one I know you're intimately familiar with, Land, from background, the heating oil unleaded gasoline spread. When's heating oil used?
Well, obviously that's what we heat our homes with, so it's during the winter times.
Yeah.
Largest consumer of heating oil is, of course, the U.S.
Exactly, and we use less unleaded gasoline then, don't we? People don't like to drive in the weather, especially if you're in Utah coming from Oregon. I don't see how you survive the winters.
But you come into the springtime, and then that's when the unleaded fuel starts to move.
Exactly. So though the general trend of we're not sure whether heating oil prices are going to go up or down, we're pretty sure that most years that heating oil is going to gain in value relative to unleaded going into the winter heating season, while unleaded would gain in value relative to heating oil going into the summer driving season in most years. Of course, nothing is for sure, but you can understand that general process of we're not sure that prices are going to go up, but one may gain relative to the other, and it makes sense from the standpoint of, if they're both overproduced, you're probably more likely to see a shortage or a jump in demand for heating oil going into the heating season than you will at the tail end of the summer driving season for unleaded.
Right.
And vice versa. in the spring.
So this is why, because you've got these different kinds of strategies that play off of each other, why spreads are considered to be a little bit more predictable.
Exactly. I think another thing that's kind of interesting is to tie it back into the liquidity issue as well. Just the fact that we've all heard the term gunning for stops, or whatever we want to call it. You don't see those games going on as much in the spread markets, strictly because you don't tend to see, it's more off the beaten path.
Well, and they're not near as spreads aren't near as sensitive to the sudden shocks of the markets as well. I mean, if you see a gap up in one contract, you're probably going to see a gap up in the other contract as well, which would, if you're using the underlying futures contract, going to be quite devastating, obviously, if you're in the wrong direction of the market, to a small trader. Gaps can jump in and take out a lot of traders. But in the in the spread side of it, both markets gap, it's not going to change the spread all that much.
Exactly. And that sort of goes to me into that increased predictability, in that you're not as subject to the whipsawing and the shaking of the latest weather or news, or how many times Alan Greenspan said inflation during a speech.
Right. And of course, back to the more predictability, as more and more systems are created for trading commodities, you start seeing a lot of this system trader type of stuff, and as they become more and more popular, some of those more and more popular system trading programs affect or can affect individual markets to some degree. People start predicting, and they start using systems because of the predictability of the systems that are being used.
Exactly. And you can't underestimate that, even beyond you and I, and we see all the advertisements for systems. A lot of the funds are run that way.
And they're the big traders. They're the ones that are moving big markets.
Exactly. These are the guys that are coming in with 100 lots and 1,000 lots. And they tend to be, trend followers. They've got entire staffs devoted to finding things that work. And they're going to look in the straight futures market more than they're looking in the spread markets. You're kind of getting off the beaten path. It's easier to find gold where people haven't looked than where it's been picked over for 100 years.
Now, we've talked a little bit about the pros of trading spreads. Now let's talk about the cons of trading spreads, because there are some. We don't want to decorate them up like a Christmas tree, because there are some cons to trading spreads and why people wouldn't do it.
I was going to say in some of our talks before we started recording, Lan saying right along the lines, and it's the number one complaint I've always heard about trading spreads, is, boy, they move slow.
Yeah.
And
a lot of the reason why we're in this commodities market is because stocks move too slowly for us. I've always said commodities are a lot of fun to trade because they're like stocks on steroids.
Yeah.
And so when we get into the commodities industry and we drop back down and say, okay, let's slow ourselves back down again.
Exactly. And
like you said, it's like watching grass grow. It's it's a much slower process.
Also, your time frames. It took me in my own trading a while to get used to holding things. I used to trade down on the floor where a long-term position was, gee, I held it for a half hour. That's big position trade.
Yeah.
And
then in the futures market, most of us hold it for. I mean, if we hold it for a couple months, we're, that's a pretty good hold for us.
Yeah, you're huge.
Yeah.
I mean, a couple of weeks is
more typical
of, that's what you consider a position trader, or most people do, to where it is not uncommon to 6, 8, 10 weeks hold a spread position.
Right. Because you have to hold it a little bit longer because it moves slower and there's not as much profit in the shorter period of times. You have to hold it longer to make the money that you're looking for.
Exactly. And if you're not geared to do that, you're shooting yourself in the foot. You know, you have to go with where your own strengths are.
Well, one of the biggest problems with trading spreads is the commissions.
Yeah, you know, I've heard it said that brokers invented spreads so they can charge us twice. You know,
Because they do. We charge. Well, I mean, the situation is that we get charged because we're buying one, we're selling the other. We pay a commission to buy one and sell the other. They don't give you a break because you're doing a spread on your commissions.
yeah, they don't look at the spread is really one transaction. Gee, we'll only charge you one commission. You know, it involves buying and selling, and brokerage's fixed cost that they pay their clearing firm and they pay the floor broker, and the whole 9 yards is based on two contracts, and they pass that along like most any other business would. Now, you can, and when you're running a business, you know, it's kind of a double whammy here as well. You're looking at smaller potential rewards out of spreads because it's less risk. You know, so risk and reward in my mind always go together. You're looking at smaller potential reward with the less risk, but you're looking at higher cost of doing business to get that smaller potential reward.
So if you're going to put on more trades, you're going to be paying higher commissions to achieve the higher rates of return.
Exactly, or you're swinging for a $600 trade, and you know you're paying $60 in commissions. Why, if you were trading an outright futures contract, you might be swinging for a
$1,200.
$1,200 trade, and you're paying $30 in commissions, or something along those lines,
Right.
just to throw numbers out.
But your risks are
You know, there is something that I
Are
would
increased.
encourage most people to do, and you know, it's another problem with spreads is they can be a little complicated.
Yeah, you need to. They took a little bit more time for me to understand it, and the concept when I first started looking at spreads, to try and figure out, the differences and why we're looking at a spread in the first place.
Yeah, and took me a long time as well, and I'm still learning. There are a few markets that I know very well,
Mm-hmm.
and there are a lot that I don't understand. You know, it is something that people tend to specialize in, and I know the general rules of thumb, but it requires a little more education, which the education is harder to get in the spread market. There's very little literature out there written on spreads.
Yeah, we looked and looked ourselves in
Yeah.
an attempt to pull together information for this educational CD-ROM and seminar, and it's scarce.
Yeah,
And
there's,
so,
I can't name more than about 3 books on the subject when you look at technical analysis or introductions to futures or, take your pick, there's 3 dozen,
Right.
easy, and I'm probably missing a 0 on that number.
yeah.
You know,
But when
so-
it comes to spreads, it's difficult to find good
yeah,
information.
so they're a little more complicated as well.
And so you're going to have to do a little bit of self-teaching as well, and experiment and learn some things yourself. And then that's the great thing about this software and
Yeah.
this plug-in, and you can go in and I didn't want to attempt spreads until I had this module and the ability to go through and actually see on the screen what the thing does and actually do some simulated trading, place the orders and watch it make a profit, and then sit here and talk to you and learn about, well, I'm not really concerned so much about the underlying price of the commodity, but more so the difference in price between the two.
Yeah,
And that's a big eye opener. It's like I really want to know the difference between those two more so than are they going up or down. I want to know, is one going to go up more than the other, and why? And this becomes very much more of a fundamental aspect to trading, much more than technical. We
Exactly.
play with the technical side of it, but this is very intriguing for the fundamental trader who looks for the underlying reasons why markets move up and down. Not only why one will move up and down, but why November will move slower than December, for example.
yeah, exactly.
And that's not a technical reason.
No, and it's the longer term nature of them. As a part of it, why it's as suited for that is the longer time frame you go out, the more fundamental, in my opinion, the trend is.
Yeah, and you know what?
And driven, but the next 3 days is fear and greed.
Yeah. Well, and recently we did the Scott and I worked together to create the seasonals seminar, which we did the seasonals plugin and gives us the seasonal natures in the market. And I really think that the seasonal information that we put on that seminar that you provided for us, telling us the underlying fundamental reasons why markets move, is really quite a key for trading spreads.
Oh, wholeheartedly. It is because you're forced to go out to a longer time frame, or you get the benefit of going out to a longer time frame, depending upon how you look at it. It is much more fundamental in nature. The longer trend, is set by supply and demand. You got to understand it.
Yeah.
And you got to understand how it shifts throughout the year, or how it should shift.